Welcome to the trading floor. I'm David Axtell. In episode 4, we completed part 1, market structure, participants, quotation conventions, the foundations. Today, we start part 2 with spot foreign exchange, the heartbeat of the market, the instrument everything else builds on. Spot looks simple. Two parties agree on an exchange rate. They exchange currencies 2 business days later, but there's complexity hidden in those mechanics. Understanding how spot actually works matters for execution, risk management, and operational efficiency. We're going to cover settlement conventions, what T+2 means and why it exists, value dates and business day calculations, how trades flow from agreement to execution, and the risks that emerge during that settlement window. Let's start with what spot actually means, because the definition matters. Spot FX refers to currency transactions that settle on the spot value date, which, despite the name, is not immediate. For most major currency pairs, spot settlement occurs T+2, 2 business days after the trade date. You agree to a trade on Monday. Settlement happens Wednesday. That's standard spot settlement. Why 2 days? Because foreign exchange involves moving money across different countries, different banking systems, different time zones. Both parties need time to confirm the trade, issue payment instructions, arrange funding, and process the transaction through their payment systems. In the 1970s and 80s, when I started in markets, settlement took even longer. Communications were slower. Confirmations happened by telex. International payments required multiple steps through correspondent banks. T+2 emerged as the standard once technology improved enough to make 2-day settlement reliable. There are exceptions to T+2. Dollar CAD, US dollar against Canadian dollar, settles T+1, 1 business day. Because both currencies operate in closely aligned North American time zones with highly integrated banking systems, the physical proximity and operational integration make next-day settlement feasible. A few other pairs also settle T+1. Dollar lira, that's US dollar Turkish lira. Dollar ruble. Dollar peso, the Philippine peso. These are specific bilateral relationships where market conventions evolved differently. But for euro dollar, cable, dollar yen, Aussie dollar, and most other major pairs, spot means T+2. Understanding value dates proves critical for anyone managing FX positions or corporate hedging programs. The value date is the date when currencies actually exchange hands, when money moves, when settlement occurs. If you trade euro-dollar spot on Monday, January 20th, the trade date is January 20th. The value date, assuming no holidays, is Wednesday, January 22nd. But value date calculations aren't just calendar days plus 2, they're business days plus 2, which means you skip weekends and holidays in both currencies. This creates complexity that trips people up. Let's say you trade euro-dollar on Thursday. Normally, T+2 would be Saturday. But Saturday isn't a business day. So settlement rolls forward to Monday, unless Monday is a holiday in either the United States or the Eurozone, in which case it rolls to Tuesday. Both currencies must settle on valid business days in their respective jurisdictions. If either currency observes a holiday, settlement rolls forward for both. This matters more than it sounds. I once had a client who forgot about a US Monday holiday. They calculated their hedge settlement would be Tuesday, but because of the holiday roll, actual settlement was Wednesday. Their internal funding calculations were off by a day, creating a short-term squeeze. Not catastrophic, but avoidable with proper value date awareness. Middle Eastern currencies add another layer of complexity. Countries like UAE, Saudi Arabia, Qatar observe Friday-Saturday weekends rather than Saturday-Sunday. When you trade dollar dirham, that's US dollar against UAE dirham, you need to check business days in both the United States and the Emirates. A trade on Wednesday might have spot on Sunday because that's the next mutual business day after skipping the different weekend schedules. Professional treasury teams maintain holiday calendars for every currency they trade. Modern systems automate value date calculations. But you still need to understand the logic to catch errors or unusual situations. Now let's talk about what happens between trade agreement and settlement, because those 2 days aren't empty time. Work is happening. Immediately after you agree to a trade, confirmations go out. Both parties need written documentation of what was agreed: the currency pair, the amount, the exchange rate, the value date, payment instructions. Electronic platforms generate confirmations automatically. Voice trades require manual confirmation, typically within the same day. Both parties compare confirmations to ensure everything matches. Any discrepancy gets flagged and resolved before settlement. Then, payment instructions go to operations teams. Treasury tells operations, we need to deliver this amount of currency, A, to this account, and receive this amount of currency, B, in this account on the value date. Operations teams verify account details, confirm correspondent banking relationships, ensure sufficient funds will be available for payment, and queue up the payment instructions. On settlement day, payments move through domestic payment systems. Dollars move through Fedwire, euros through Target 2, yen through BOJ.NET, Bank of Japan network. Each system has specific operating hours and cutoff times. Miss the cutoff and your payment doesn't settle until the next business day, which creates a failed trade scenario with potential penalties. The risk during this settlement period is called settlement risk, or Herstatt risk, named after a German bank that failed in 1974 while settling FX trades. Herstatt risk works like this. You're trading euro-dollar. You pay euros to your counterparty in the morning European time. You expect to receive dollars from them in the afternoon New York time. But before New York opens, your counterparty fails. You've delivered euros but received nothing. You've lost the full principal amount. That's the risk. This actually happened. Herstatt Bank was closed by German regulators in June 1974 after making multiple bad foreign exchange bets. The bank closed after European markets ended, but before US markets closed. Banks that had paid Deutsche marks to Herstatt, expecting to receive dollars, got nothing. The loss was substantial. The disruption to the market was worse. It created immediate mistrust. Banks became reluctant to settle with each other without certainty of reciprocal payment. The solution was CLS, Continuous Linked Settlement, a specialized bank that acts as a central counterparty for FX settlement across 18 major currencies. Instead of two parties settling bilaterally, both parties settle with CLS. CLS receives both currencies simultaneously, then CLS pays both parties simultaneously. Payment versus payment. You only pay if you receive. You only receive if you pay. This eliminates principal risk. If either party fails to deliver, neither payment goes through. The transaction unwinds safely. CLS settles over $6 trillion daily across 18 currencies. It operates during a window from 7 in the morning to 12 noon Central European Time, when all relevant payment systems are open simultaneously. Not every currency is CLS eligible. Emerging market currencies typically settle bilaterally, which means settlement risk still exists for those pairs. You need robust counterparty credit assessment and appropriate limits. Let me give you a practical example of how this flows in real trading. I'm a corporate treasurer. My company has receivables of 10 million euros coming in next week. I want to convert to dollars. I call my relationship bank. We agree on a rate. Let's say 1.0850. Trade date is Monday. Value date is Wednesday, T+2. The bank confirms the trade electronically. I receive confirmation showing I'm selling 10 million euros, buying $10,850,000 at 1.0850 value date Wednesday. I forward that confirmation to my operations team. They verify our euro account has 10 million euros available Wednesday morning. They confirm the bank's payment instructions for receiving dollars. They schedule the euro payment. On Tuesday, my operations team does a final check. Euros available, payment instructions confirmed, ready to settle. Wednesday morning European time, we send 10 million euros through Target 2 to the bank. This happens early in the CLS settlement window. Simultaneously, the bank sends us $10,850,000 through Fedwire. CLS coordinates both payments. We receive dollars, bank receives euros. Transaction complete. My cash management system updates. Euro balance down 10 million. Dollar balance up 10 million. 850,000. The trade is done. That's the flow for a standard spot transaction, and it happens millions of times daily across the global FX market. Now, there are faster settlement options for urgent situations. Same-day value, called cash or today value, settles on the trade date itself. You agree to a trade at 9 in the morning. Settlement happens before end of day. This requires immediate funding, immediate payment processing, rapid confirmation. It trades at a premium or discount to standard spot rates, reflecting that urgency. I've used cash value for emergency situations. A client had an unexpected payment due that day. We executed a cash value transaction. Higher cost, but it solved the immediate problem. Tomorrow value, or TOM value, settles T+1. One business day, sits between cash and standard spot, useful for minor timing adjustments or rolling positions forward by one day. These faster settlement options exist, but they're significantly less liquid than standard spot. Spreads are wider. Availability depends on dealer willingness, not something to rely on routinely. Understanding spot mechanics also matters for interpreting market data and pricing relationships. Spot rates quoted in the market are for standard value date settlement. When you see euro-dollar 1.0850, that's the rate for exchanging currencies 2 business days from now. If you want to exchange currencies today, or tomorrow, or 3 months from now, those rates differ from spot because of interest rate differentials and time value of money. Forward rates build on spot rates. Swap rates connect spot to forward rates. Options reference spot rates for strike determination. Everything traces back to the spot market. Which is why spot is called the heartbeat of FX. It's where price discovery happens, where the largest volumes trade, where all other instruments reference for valuation. One more critical point about spot trading. Volumes and liquidity vary dramatically throughout the day. The FX market operates 24 hours, but it's not uniformly liquid across that entire period. Asian session, roughly midnight to 8 in the morning London time, sees lower volumes, primarily regional flows, Japanese exporters hedging, Australian commodity-related trading, Chinese fixing activity. But relatively quiet by global standards. European session, 8 in the morning to 4 in the afternoon, London time, sees volume increase significantly. London is the largest FX centre globally. Major banks' European desks are active. Corporate hedging flows pick up. Real money flows from asset managers. Then the overlap, 8 in the morning to 12 noon New York time, noon to 4 in the afternoon London time. This 4-hour window is peak liquidity. Both London and New York are active simultaneously. Tightest spreads, deepest liquidity, best execution. Euro-dollar spreads during the London-New York overlap might be half a pip. During Asian session, they might be 1.5 pips. Same pair, different liquidity. Professional execution strategies account for this. Large orders often execute during liquid hours to minimize market impact. Small urgent orders might trade any time, but understanding the liquidity cycle helps optimize execution. Let me close with why all this matters. Why spend 20 minutes on settlement mechanics and value dates and payment systems? Because spot FX is infrastructure. It's how international commerce happens, how companies repatriate profits, how investors diversify globally, how banks manage their balance sheets. When that infrastructure works smoothly, nobody notices. When it breaks, the consequences cascade quickly. I've seen settlement failures create temporary funding crises. I've seen value date miscalculations throw off monthly reporting. I've seen clients pay significant premiums for emergency same-day settlement because they didn't plan ahead. These aren't theoretical risks, they're operational realities that affect actual businesses with real financial consequences. Understanding spot mechanics helps you avoid those problems. It helps you plan better, execute more efficiently, manage risk more effectively, and it gives you the foundation for understanding everything else in FX markets, because forwards, swaps, options, all the derivatives, they all build on spot. That's Spot FX, the heartbeat of the market, T+2 settlement, value date calculations, payment flows, settlement risk, and how CLS solves it. The infrastructure that makes $7.5 trillion of daily FX trading possible. Next episode, we'll talk about execution, how trades actually get done, the difference between voice trading, single dealer platforms, multi-dealer platforms, electronic communication networks, algorithms, and high-frequency trading, and how to think about optimal execution depending on what you're trying to achieve. Before we close, I want to mention a resource that complements this podcast. Luigi Rondinini has built a comprehensive FX education platform at learn.rondinini.com. It's designed for practitioners who need depth beyond introductory material. The platform features over 120 professional modules covering FX cash products, derivatives, interest rate markets, portfolio management, risk frameworks, and regulatory compliance. Each module provides institutional-grade content, worked examples, Python implementations, and practical tools you can use immediately. Individual modules are priced at 99 pence to £2.49, making professional education accessible without requiring thousands of pounds for comprehensive courses. You can build your knowledge module by module, focusing on exactly what you need. The platform also includes the complete Python toolkits that accompany our book series, production-ready code for pricing, risk management, and analytics. If you're a corporate treasurer building a hedging program, an FX trader developing your expertise, or a risk manager implementing frameworks, learn.rondinini.com provides the depth you need. Check it out. It's built by practitioners for practitioners. I'm David Axtell. Thanks for joining me on the trading floor. If you're finding this series useful, subscribe wherever you get your podcasts. We release episodes weekly. And if you want the book that covers all of this in comprehensive detail, FX Cash Products by Luigi Rondinini and myself is available through Rondinini Publishing. See you in episode 6.